Let's work exercise 16.4 from chapter 16. This is related to entries for available for sale securities. So as always, we'll read the problem, set up the facts, and then we'll solve for the questions. So it says, assume the same information from exercise 16.3. So let's scroll up and take a look at 16.3. So it's similar to this, except it's a different, they're going to ask us for different questions. So let's capture the facts. So this is dated 1/1/2025. So January 1st, 2025, high and low company purchased 12% bonds having a maturity value of $300,000 for $322,744.44. Okay, so the interest rate on these bonds is 12% per year. The maturity value, which is also the face value, is $300,000, and cash paid for us to acquire these bonds were, so we paid $322,744.44. Let's see, the yield, which is the market, the yield rate is targeted to be 10%. And as we mentioned, they're dated January 1, 2025 and mature 5 years later. So this term is 5 years as they mature on January 1st, 2030. Interest received on January 1st of each year. Interest payments on January 1 of each year. It says they use the effective interest method to allocate unamortized discount premium. The bonds are classified and held to maturity. Okay, that's going to be a little different. So now let's go down and read our problem. So we've got the same facts that were given to us. So we've got those summarized here, except that the securities are classified as available for sale. Okay, so these investments that we've purchased some bonds that have a face value of $300,000. We paid $322,744. So we paid a premium for these bonds. Let's see, which makes sense because the market rate is 10%, yet these bonds pay at 12%. So there is an increased interest payment. So that would lead us to think that there would be a premium. They're 5-year bonds, and they're going to mature in 5 years on January 1st, 2030. And we're going to receive interest payments on January 1st of each year. And the problem says we're going to classify these as available for sale. And then we have some fair value of the bonds at December 31st of each year as follows. So 1 year in, the fair value is $320,500, and then 309, then 308. Then it went up a little bit to 310 in 2028, and then it closed out at 300,000 on December 31st, 2029, which makes sense because the very next day, January 1st, 2030, the bond matures at 300,000. So our instructions: prepare the journal entry at the date of the bond purchase, and then for part B, we'll record the interest revenue recognition of fair value for the first year, 2025, and then we'll do the same thing for 2026. All right, let's start with part A, which is to record the journal entry on the bond purchase, which was January 1st, 2025. All right, so we're acquiring an asset in exchange for cash. So we're going to debit the asset that we're acquiring. In this case, it is an investment in a bond. So we're going to call that debt investments. And we're going to credit cash. And the problem told us, let's see, that the cash paid was $322,744.44. Let me stretch these columns out a little bit, give us some room. And I'll convert these to numbers. So we debit debt investments for $322,744.44, and we'll also credit cash for the same amount. Now we have the asset on the books. Now, similar to what we did with bonds, when we sell a bond, now in this case, we're actually the one that is buying a bond. So we're still going to have to amortize that debt investments all the way to $300,000 at the date it matures. So as we go throughout the next 5 years, and we see in B and C, we're going to practice doing a couple of those years where we're amortizing this towards the $500. I'm sorry, towards the $300,000 in 5 years. So let's move to journal entry B. So B is asking us for the journal entries to record the interest revenue and recognition of fair value for 2025. So let's first do the interest revenue. And this is 12/31/2025. Okay, so the interest payments are received on January 1st. So therefore, at December 31st, I have a receivable. I'm going to record an interest receivable related to the amount that is due on the bond. So we bought $300,000 and the interest rate per the bond is 12%. And it's paid once a year. So principal times rate times time is 300,000 times 12 times 1 year is $36,000. And then I need to credit the debt investments because remember, we're going to amortize that towards the $300,000 after 5 years. And I'm going to credit interest revenue. Let's calculate interest revenue. So these bonds that we invested in, $322,744.44. That's the amount that the bond is on our books for from January 1, 2025, all the way through December 31st, 2025. So that carrying value of this instrument that we've invested in is $322,744 for the entire year. And the problem told us that these are designed to yield 10%. So that carrying value times 10% means that I'm going to record interest revenue of $32,274.44. Therefore, just like we did when we issue a bond, in this case, we purchased a bond and we're going to amortize based on the difference between the interest receivable and the interest revenue. And that is going to be a credit. Move to the credit column. And I subtract the difference between $36,000 of interest receivable and $32,274 of interest revenue. And I get that my amortization to the debt investments is $3,725.56. That's the first part of the request for this problem, to record the interest revenue. So now let's record the recognition of fair value for 2025. So we're still at December 31st, 2025. We will have a debit to the fair value adjustment account, and we'll have a credit to the unrealized holding gain or loss. And this is an equity account. Now, because we're doing this available for sale, this is going to look a little different than what you would solve for 16.3 above when it was held to maturity. Remember, available for sale is that at any point during the time we could sell. Our intention is that we would be able to sell these at any point in time during the 5 years that we possibly would own these bonds. We could sell them at any time. In 16.3, it told us that we would hold them to maturity. Therefore, our intention was to hold them for the full 5 years. But here we don't know, we're not committed to that. So they are available for sale. So we will record any recognition using this journal entry format, any change in fair value using this journal entry format. Okay, let's see, what is that amount going to be? So the unrealized holding gain or loss, in this case, it's going to be a gain. And the reason for that is that we will look at our carrying value and we will adjust accordingly. So let's calculate what our carrying value is. Let's see, debt investments at 1/1/2025, and that amount was $322,744. And then we recorded an adjustment to that in the previous journal entry of $3,725. So that means our remaining carrying value of the debt investments is the net of those two. So they're on the books for $319,000 right now. However, because we are available for sale, we're going to adjust that to market value. So let's see. So they're on the books for $319,800. However, the problem says that at December 31st, so if we look back at the problem in the book, we see that December 31st, 2025 fair value of these bonds is $320,500. Yet we only have $319,000 recorded. So we're going to adjust that. So that's going to be the difference between the fair value given to us in the problem, which is $320,500, minus what is currently on the books, means I need to record an adjustment of $1,481.12. And that will also be the corresponding debit to the fair value adjustment account. So we won't actually realize that until we dispose of the bonds. So therefore, we hold it in a fair value adjustment account with the offset to the equity account unrealized holding gain. Next, we're ready for Part C. Part C says, prepare the journal entry to record the recognition of fair value for 2026. So we don't need to record the interest receivable and all that again. So we're just going to go straight to the recording of fair value. So let's see, our carrying value now let's see, I will show, trying to see how I'm going to fit this on the screen here. What we do know is that the fair value is $309,000. So after our adjustment, we're going to record the difference of that to any unrealized holding gain or loss, but we need to determine what that amount is. So let's, we're going to need to figure out what the carrying value is. Did I start it? I didn't. Yeah, let's add some rows in right here. Okay, so we left off with the carrying value of the bonds were $319,000. Yep, we're going to have to record the journal entry. We're going to have to calculate the journal entry anyway. So let's start with that. For interest. Okay, I'm going to copy this down and we're going to record. I know it's not asking, but we need this amount right here. So our interest receivable is always going to be the same. They're going to owe us $36,000 because that's $300,000 bond, 12% interest for one full year of interest. It's always going to be $36,000. Interest revenue represents the carrying value. So the carrying value for the entire year was $319,000 times 10%. And so in this case, the credit to the amortization for the debt investments is $4,098. So I need to record that here or document that here. So debt investments amortization for 2026 is the $4,098.11. And this will get me to the remaining carrying value of the investment at the end of 2026. All right, so what's happened here is I needed to know how much the debt investments account was going to be adjusted. So I calculated that first journal entry just like we did before. Even though the problem's not asking us to record this journal entry, I need to know what the amount of the credit to the debt investments is. And so I recalculated that journal entry for 2026. We arrived at $4,098.11. And so I'm adjusting the carrying value. Remember, this carrying value is approaching $300,000. But because it's available for sale, we're also going to adjust it to market value. And so I need to perform that second journal entry to adjust it to fair value. So the carrying value on the books, I will have an asset on my balance sheet with a carrying value of $314,920.77. And then I'm going to record a similar journal entry. I need to adjust that number to market value. And I look at my market value, and it's only 2026 is only $309,000. So if I want to adjust that, I have the carrying value of my debt investments. I need to determine what this adjustment is going to be for this journal entry. So my carrying value is $314,920.77. The fair value of these debt investments given to us in the problem, December 31st, 2026, is $309,000. So the total unrealized gain or loss, in our case, it is going to be a loss because the fair value is 309 and the carrying value is almost 315. So we're going to have a loss here, unrealized loss of $5,920.77. But we also have to consider the prior adjustment. This is the cumulative number, is $5,920. However, some of this we've already recorded. What did we record previously? We reported a gain, an unrealized holding gain of $1,481.12 in the prior year. So we're going to have to adjust for that. Subtract that gain out, $1,481.12, means that my fair value adjustment for 2026 is the combination of those two amounts, $7,401.89. Now I can make my journal entry. So this is a loss. So we're basically wiping out that previous gain and swinging an additional $5,920. So we're wiping away the previous unrealized gain, and we're recording the adjustment to get the new amount, 315, to the fair value amount of 309. Is about $6,000. So total adjustment is, combine those two amounts, $7,401. So debit unrealized holding loss, and this is again in equity, $7,401.89, and then credit the fair value adjustment account. $7,401.89. And we'll continue that process every year. This does conclude the problem, so it didn't ask us to continue into 2027. Again, this is an example on how to treat a bond debt investment when management's intention is that it is available for sale versus held to maturity or a trading instrument. So therefore, we record the fair value adjustment each period into a holding account inside of equity. In this case, we're calling it unrealized holding loss or gain, depending on the year, with the adjustment to the fair value adjustment account. So at this point, this does conclude the example to solve exercise 16.4, entries for available for sale securities.